Good morning. It's still the morning. 2 more minutes and it's not the morning. But we have another couple minutes here. So let's see if we have a successful launch. We're going to actually officially get started here in 1 minute and 31 seconds. And it looks like the YouTube machine is kicked into gear. And I should be unmuted right now. So as soon as everybody gets situated here, let's get a reality check on whether or not I have this thing set up properly or not. Appreciate the thumbs up on the YouTube. We already have 2. We haven't started yet. Lee, how are you? Thanks for being here. I'm assuming you could hear me okay. Dashal, thank you for being here. Bargav, thank you. Reza, sweet. All right, we got some, we got confirmation that we're ready to go. We're going to give it another minute here before we get started. So I can see the questions for YouTube and I can see the questions on Zoom. I can't see the questions on Facebook, so I'm going to ask my trusty sidekick, Isabella, to help with that. So appreciate that. Thanks, Isabella. The Boneyard. Hey, Jim. Says to me, hey, back to the Boneyard. Don't know if I want to know what that means, but that's okay. All right, everyone's hearing me fine. All right, it's starting time. It's noon here on the East Coast, or 11 o'clock if you're in Central Time. And my guess is we have folks from all over the place coming to these events, which is awesome. Again, thanks for the thumbs up on the YouTube. My name is Jim Cagnina. I'm a senior education and training specialist for the NinjaTrader platform. For those of you who are new to these events, you might not know me. I do want to remind everybody trading futures, options on futures involves substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. Although that could be equation for opportunity, also equation for risk. So be careful, only fund your futures trading account with risk capital. My personal definition, money I could afford to lose, does not change my lifestyle, does not lengthen my retirement horizon, and doesn't overly stress me out. So that's kind of my personal definition. We know everyone's unique and different here. So just be careful and be careful with the day trade margins also. Use those gingerly. Steve says, good morning, good afternoon from Spain. Well, welcome from Spain. That's awesome. Never been to Spain. Like to go. Daniel said it's the best place he's ever been. Sorry, I'm dating myself. Is everybody here new to futures? Are we all brand new, or UK is here? Yeah, that's awesome. I've been to UK a couple times. If you're brand spanking new, well, that's okay. It doesn't matter if you're new, if you've been here a while. We're going to cover some ground here, and I'm going to use the trading platform to kind of tell the story. And it's nowhere near as complicated as it looks. If you're brand new to future trading, you're going to see this and be like, what is that? Dashel is brand new. Don't worry, I'm going to take the mystery out of this. And we're going to go. We have a ton of time. This is we're scheduled for an hour. If we go longer, we go longer. No worries. Type in your questions as we go too. If I talk too fast, let me know. We got Southern California here, CPJ. I've been there. I've been to Southern California. Love LA. My wife wasn't crazy about it, mostly because of the traffic, but I loved it. Laid back, great weather, great restaurants. All right, what are we talking about here? This is Futures Trading 101. So trading's been around for a long time, right? And you know, everybody remembers the world history. You know, the Greeks and Phoenician trade merchants established trade routes throughout the Mediterranean and started trading things, right? Trying to get value out of stuff they had and vice versa. Maybe officially, exchanges kind of became official as early as 1571 in London, where the Royal Exchange was first kind of officially formed. 1667, the Dojima Rice Exchange. It's important. D-O-J-I-M-A, Dojima. And, you know, candlestick analysis comes from that. And the word doji is a type of candle formation comes from that. So so technical analysis has been around for a long time, and these are this is a commodity market, right? Although the Royal Exchange wasn't, it did other stuff, but it did a lot of different things. But Dojima was, and then in the mid 1800s, 1848 to be exact, the Chicago Board of Trade creates the first futures exchange based in Chicago, and that's where I'm from, and that's where I started my career in the early 80s. And then I don't know, about 22 years later, the CBOT developed the first octagonal futures trading pit. Everybody remembers the octagonal futures trading pit. And then around the turn of the century, the Chicago Butter and Egg Board was formed, and that was the predecessor of the CME Group, the Chicago Mercantile Exchange, I should say. Right then there, 1898. Now, so I mentioned I started on the floor of the board in the early 80s, and back then futures trading was not accessible to everybody, right? So there was several pretty good futures trading markets. Many of them were commodity markets. The grains, wheat, oats, those kind of things that you're traditionally used to hearing in conjunction with futures trading. But other markets started to form as well in the early 80s. The S&P got very popular. Treasury bonds in the 70s got really popular. I was in the U.S. Treasury bond pit. It's in the summer when I was going to school, I'd go down. My uncle was a trader and I was a clerk. And, so the way it worked is, if you wanted to trade futures as a retail trader, you would have to open an account with a third-party brokerage firm. And then you would have to, somehow get a newsletter service or something to be able to look at the newspaper, to decide what kind of trades you'd like to make. Call your broker. Your broker would call the desk on the floor. And then some guy or gal would write down your order on a piece of paper, hand it to me. I was a runner, a kind of clerk guy. I'd run it over to the pit, give it to a guy who was a broker on the edge of the pit. He'd turn around and give it to a filling order broker who would place the trade. And then once the trade was placed, they would write it down on a piece of paper, hand it back to me. I'd run it back to the trade desk. The trade desk then would call you or call your broker. And then your broker would call you and say, okay, you got filled. And sometimes this process took minutes. Sometimes this process took many hours. And so it wasn't very efficient, obviously. It was efficient for the folks on the floor, but it wasn't, unless you had the six-figure backing to actually lease a seat on the floor and you wanted to do that for a living, you didn't have the access, right? So the CME in 1982 formed the S&P 500, like we talked about, the stock index, which is very popular, key benchmark market. And then in 1992, 10 years later, they launched the CME Globex electronic trading platform. And now trades can be matched electronically side by side with trades being matched in the pit. So that was kind of the first innovation. And that's that started everything rolling in the right direction. But really where the retail traders got a lift was in the late 90s. We're all dialing into the internet with America Online and we had this data. We had trading platforms now that were starting to come out. And in 1997, CME launched the E-mini S&P, which is a smaller size contract than the big pit-traded S&P, right? So now, not only did we have this electronic access to this E-mini S&P, but we also had a smaller size contract, which enabled us to participate with less investment capital. So more folks are able to participate at that point. It expanded the universe of traders. And not only that, the trades were electronic and they were executed on a fair basis. FIFO, first in, first out. 2002, CME's first exchange to go public. 2007, the CME and the CBOT merged. Then the CME acquired NYMEX after that. And the most important thing I think that's happened in this whole history, this whole timeline, is from a retail trader point of view, is the emergence of the micro futures. Micro E-mini futures were launched May 6, 2019. And now retail futures is really accessible to just about everybody, right? Smaller size contract, easier to participate with smaller size capital in your account. And they're terrific markets. And we'll talk a lot about those as we go forward here, going forward. And hang on one second. Make sure I have that all posted. I do. Okay. So let's start by looking at the trading platform, and it's modular, right? It's downloaded on my PC and my laptop. I have a big monitor hooked up to my laptop, and everything is, you could position these windows however you want. You could open as many of them as you want. It's very customizable, and so I'm just going to move this around just to show you how easy it is to set it up. And this is how I have my desktop set up. And so I'm going to use this kind of layout to kind of get into detail about what futures trading is. And at the top here is the control panel where I could open up new windows. I could connect the data feeds. I could save workstations. I could see my positions, my accounts. I could see my executions. I could see my orders. All that stuff in a really easy format. Now, we are logged into simulated live mode right now. I'm in a simulated live account with a real-time data feed using the NinjaTrader software, which just won I think the Benzinga Award for best futures trading platform. So that was pretty awesome. In any event, that's kind of the control panel, right? Okay, so let's kind of go to the right here. Let's look at the Superdome, NinjaTrader Superdome. I'm going to move this over, position this over in the middle a little bit so we can see it a little better. And this is really where the rubber meets the road in futures trading. You don't, Barbie Mrs. America Online. You don't get this type of market view really anywhere else. I mean, maybe if you're a pattern day trader, you'll see a trading ladder with a portion of the market being represented on a volume point of view. But with respect to futures trading, especially through the CME Group's Globex electronic trading platform, we have globally recognized benchmark markets where we can see the whole playing field. This right now, I have my trading ladder set up just to show the E-mini S&P. We talked about the E-mini S&P, and we talked about the micro E-mini S&P, but this is the E-mini S&P stock index futures market, large cap stocks. Everyone's familiar with it. Turn on the TV in the morning and you see S&P is up this, S&P is down that. And it's globally recognized, right? Globally recognized. Now, it's also called a depth of market or a price ladder, Superdome. And the price ladder is obvious, right? We have prices in the middle, and they increment up in 1/4 increments, 1/4 point increments, and that 1/4 point increments called a tick. It's this, or if you're trading over the counter forex, you might recognize it as a pip. But in future trading, we call it a tick, and each tick on this particular market is worth $12.50 per contract per each increment. Since it's traded in quarters, 4 ticks equals 1 point, or $50 per contract would be the value. If you bought a contract, and I'll give you an example later. I have a spreadsheet to show you some trade examples, but just remember that that's one whole tick. Now, different markets have different tick sizes, right? And we're going to cover all those other markets. But so this is one kind of unique thing about futures trading. The second thing is, on the left-hand side in the buy column, you'll see a whole bunch of numbers, right? And those numbers are moving. It's dynamic, things are happening. And those represent limit orders that were sent to the exchange at various prices to buy an E-mini S&P contract. S&P contract. And these are 10, you could see 10 ticks deep, 10 price points deep. You could see the volume at any given time on the bid side, and on the offer or the sell side, you can see it 10 ticks above the last traded price, and it's called depth of market. 10 ticks deep, depth of market, level 2 view on the trading ladder. And people are adding to their limit orders, canceling them, replacing them, doing all sorts of stuff. And so it's very dynamic. It's very dynamic. In the middle of that yellow flag, right there, I'm going to freeze my ladder by putting my mouse on here. 46, 47.5. That's the last traded price. That's the last time a buyer and seller agreed to do a deal, and that's the price that deal happened at. Now, they didn't pick up the phone. Obviously, it was just electronically matched on a first come, first served basis by the exchange. And what you'll notice here is on the right-hand side, you'll see 39. That's 39 offers in the trading book. Those 39 limit orders to sell at this price. And on the right-hand side, you're going to see 114, 1 tick below it. It's 114 contracts to buy limit orders to buy on the buy side. And the difference between the two is called the bid-ask spread, right? The bid-ask spread. And the way I would say this now, I would say 47. I would say a quarter bid at 50. Market trading quarter bid at 50, and it's moving around behind the scenes, as you can see on the chart. So the good news is here, the bid-ask spread is it can't get any tighter than this, right? It can't get any tighter because there's no gap between the offer and the bid price, which means this is a liquid market, right? This is a good thing. Liquidity is important, and we'll talk more about that in a little while. Now, to even make matters better, right? To place a trade, literally, you could just pick a price. Let's say I want to buy a contract at 46.45 and a half, and I'll just move my mouse over there, and I'll click once. Now, this is a simulated live account, but if this were a live account, that order would be sent to the exchange, and I'd get this little flag here back on my trading ladder that says, I'm trying to buy a contract at 46, 44 and a half, right? And my idea is if the market gets down there and if I get filled, I'll have bought one. And then I hope that the market then goes back up and I could sell it at a higher price, right? Now, the number 197, I'm behind 197 contracts now. So I'm in line. It's like when you're in line at the bagel store and you want to get an everything bagel, but there's only so many of them that are made, and you have 15 people in front of you. Those folks have to be filled, get their bagels first before you get up to the front of the line. And if there's any available, then you get yours. Same thing is here, right? So once inventory is exhausted here, and when you're at the front of the line, then you have a chance of getting yours. And alternatively, if there's nothing left in the tank here, there's no more sellers, the market could rally back up and you don't get yours. So that's a possibility. But alternatively, the market can't trade at 44 and a quarter and one tick below where my order is without giving me my fill. So I'm kind of blocking the market from going any longer if you think about it that way, any lower if you think about it that way. Okay. So I just clicked once to buy, and then if I wanted to sell, let's say up here at 49, even I just click once again, right? So I have an order to sell up here, I have an order to buy up here. And so this is one of the unique things here about using the NinjaTrader Superdome is it's very nimble and very easy to get in and out of positions. As a matter of fact, if I change my mind and I'd like to lower this price to a different number, I just click on it once and I move it down, I click on it again. And it's really that fast. I could place stop losses on this ladder as well, and all sorts of things. If I want to cancel everything, I could just hit close. It cancels everything. I could do a market order down at the bottom to buy, a market order down at the bottom to sell. I could flatten a position. I could hit the reverse button. So this trading dome it's got a lot of functionality to it, and it's a lot easier than typical order entry methods where you're literally clicking, typing in a price, typing in a limit order, typing in a good till day, good to close, whatever criteria you're going to put on that regular trade, that cash market trade, similar to cash markets or over the counter or CFDs. This gives you the ability to really kind of ease of order management. So I'm just going to cancel everything. We're going to start over. So that's the trading ladder. And again, it's super unique to futures trading. This is the only E-mini S&P futures market in the world. So all of these bids and offers are seen by trade. It's transparent, right? So a trader in New York is seeing the same thing as a trader in Japan is seeing the same thing as a trader in Southern California. Is saying that this is all transparent. All these prices, these are measured in milliseconds, the stata feed, and the prices are transparent. There's no middleman, right? There's no brokerage firm that's going to take your order and then push it off to and sell your order. This is the exchange. We're looking at it right here. We're looking at the exchange. So again, unique to futures trading. There's all sorts of features. I could add tabs at the bottom to toggle between different marketplaces. Here's the NASDAQ 100. Here's the crude oil. And there's all sorts of different asset classes, which we're going to cover in a second. Alternatively, advanced trading platforms like NinjaTrader, you could also trade from the chart itself if you want. You don't have to trade from the trading ladder. You could just simply put your mouse there and place a trade if you want. If I wanted to sell a contract up here, I would just right click and I would, send an order in to sell, right? And I just did that. I just right clicked. I hit what I wanted, and then it's mirrored on the trading dome itself. These two things are in sync, right? So another reason why this type of trading is so easy to execute, maybe not easy to trade, but easy to execute, is because of the great software. And what I just did is I put an order to sell, and I'm interested in this case. And again, don't follow me live at home. This is just a sample trade. It's I could sell or I could buy, or I could buy or I could sell. There's no uptick roll. You don't have to worry about an uptick roll. And then once I sell or once I buy, then I'll have a position, right? I'll have a position. So it's let's see if we can get a position right now. We'll try. One of the things I want to point out to you also is we want to talk about margining too, because margining is also unique in futures trading, right? You're not borrowing money from the broker. You're not borrowing money to put up margins for a trade. And in futures trading, there's a couple different kinds of margins, right? There's a margin that's set by the exchange themselves if you're going to position trade and hold positions for a longer period of time, overnight or longer. And then there's day trade margins or intraday margins, which your brokerage firm sets, which allows you to trade with with a smaller margin requirement, and doesn't as long as you liquidate the position by the close of the day. In the close of the day, remember, this is a 23-hour marketplace, right? 23-hour marketplace. We open up at Sunday at 6 o'clock Eastern time and go all day and all night to 5 o'clock in the afternoon, and then take an hour break, 1 hour. So the overnight is 1 hour, and then we start again. And Monday night, we go all night, all day until the close. And that cycle repeats itself all the way till Friday at the close, 5 o'clock. And then we take Saturday off. Everybody gets Saturday off to do what you want to do. So now we've just saw the market kind of, it's volatile, bounces around a little bit. We just kind of, our limit order was executed, right? And remember, we're in a simulated live account. And a couple of things I want to point out here, which is unique. Intraday margin column, you'll see my cash value here. I started out at $6,461. And by establishing this one contract position, I'm short one contract. I'm using $500 of my intraday margin, and I'm not wiring this money anywhere. This is money that's already in my account, right? This is money in my account, and from accounting point of view, it's just 500 of your $6,461 is allocated for the trade, the position that we have established already. The excess intraday margin, this next column, is just the difference between the two. Plus or minus your unrealized P&L. I'm just saying, hey, here's how much excess intraday margin you have left, right? You could place another contract. You could do another contract in this particular market, or you could do a contract in a different market if you want, right? You could have multiple markets going at the same time. It's totally up to you. So that's how intraday margins works. Now, as soon as I liquidate my position, right? Let's go ahead and liquidate my position. I'll just throw another limit order in to buy it back at one tick lower, and just see if we can get a little bit of luck going here. And that margin. All right, so we're filled on that. The margin is immediately released. Look at my intraday margin is now 0 instead of 500. So I could place another trade. I can immediately turn around and place another trade. Then again, it's going to say I'm using 500 again. And that's how margin works. It's immediately released when you're done using it, which again is, unless you're a pattern day trader and you're putting up $25,000, and meeting a whole bunch of other criteria, you don't have that barrier, that restriction here in futures trading, right? You don't have that. You're not limited to the amount of trades you could make. You don't have to wait for settlement. like you would in a over-the-counter Forex trade, 3 to 5 day settlements. You have to close the position. The positions aren't fungible, and it's just a different experience. And the same with the regular equity account. So again, another one of the unique benefits of trading these markets. This column here, excess intraday margin. I'm sorry. Where are we at here? This top line here. Okay, this top line. The initial margin. Let's get filled here first. We didn't get filled there. That's why it's 0. Okay, I'm short again. And what you'll see on the initial margin here is it says 12,650 instead of 500, right? 12,000. This is because the exchange sets overnight margins. In other words, how much money you need to have in your account to establish and hold a position past the close. And as odd as it sounds, close is just the night session is just 1 hour, right? And then day trading margins typically, depending on the brokerage firm, kick back in when the nights, when the market reopens an hour later. But for position traders and portfolio managers and investors, that number is that's what you need to have. And the exchange sets it, right? The CME group sets it. In this particular case, if you're trading Eurex products, Eurex exchange would set that. And remember, these exchanges are highly regulated, right? They're highly regulated, publicly traded in the CME group case, CFTC regulated, among other entities, with pretty strict requirements on how everything is handled. So this is what they do. This is how they set it. So day trading, you have a lot of flexibility, which means you could have a lot more leverage. And I'm gonna show you a leverage example in a second. And actually, you know what? I'm gonna show it to you now. Let's just show it to you now. Let me pop in here. I got a couple of examples here. I have a winning trade example for the classic E-mini. I have a losing trade example for the classic E-mini. Same market we're looking at on our trading platform. So let's say the trader decides to use one contract and buy a contract at a price of 41.20, and then turn around and sell that particular contract at a price of 41.24. And I made the spreadsheet a while ago. That's why the numbers aren't in line with the market as we see it today. But that would represent a 4-point winner, right? And remember, each point's worth $50. So when you multiply 50 times 4, you have a gross profit of $200. In that trade, we would have used $500 of our day trade margin, which would have been returned to us once we completed the trade. Not returned to us, but which would have been made available to trade again. And then the notional value of this contract, the buying power or the leverage you have, is the way you calculate it is you take the point size, which is $50, and you multiply it by the price. In this particular example, your notional value of this contract, this trade, was $206,000. You're controlling $206,000 worth of S&P 500. So you can see with just one contract, you have a decent amount of leverage going. So as an example, if you had a $5,000 trading account, you would be using $500 of your day trade margin, or 10% of your day trade margin or intraday margin. Let's scoot over to a 2-contract trade, same prices, same point P&L, and the profit and loss would be double, right? Because we're doing 2 contracts. It's multiplicative math. It's pretty straightforward. And so 2 contracts, it would have been a $400 positive P&L, and we would have used $1,000 of day trade margin. Remember my example of a $5,000 capitalized account, you would have been using then 20% of your day trade margin. Notional values doubled, 412,000. On a 5-contract trade, multiply everything by 5, and you get $1,000 P&L. You have a $2,500 day trade margin. Now we're using 50% of our day trade margin, and then the notional value is $1 million. So you could see that you are afforded the ability to do leverage transactions here. But I do want to remind everybody, it's easy on the day trade margins, easy on the number of contracts that you trade in relationship to your account size. because a lot of times that kind of compounds losses as well. And we can see it in the next, in the losing trade example. I did exactly the same thing. I bought at 41.20, but the market went against me. I sold at 4 points lower at 41.16, and everything is the same except it's negative, right? I lost 4 points. My gross P&L is minus 200. Day trade margin is the same. Notional value is the same. I do 2 contracts. I lost 400. Day trade margin was the same. And then if I did 5 contracts, I lost 1,000. And you can see if I would lose $1,000 in a $5,000 account, I lost $20,000. I'm sorry, 20% of my equity in one trade. So again, you got to be careful with that leverage, but that's how the math works. Now, there's another alternative called the micro E-mini contract, which you touched on. And this particular contract is the exact same basis, right? Of the S&P 500 stock index futures. It's the contract size is 1/10 the size smaller. It's a smaller size contract, but the basis is the same. S&P 500, large cap U.S. stocks. And it's a widely followed index. It's all based on the same thing. In this particular market, everything's 1/10 the size is different, right? So on my 1 contract trade, instead of a $200, 4-point winner, it would be a $20 P&L. I'm using $50 in day trade margin, and my notional value is still pretty darn big, 20,600. Double it up. It's $40 P&L, $100 day trade margin, and then if you did 5 contracts, it would be $100 or 250 day trade margin. Now, keep in mind, if you did 5 micro contracts, that's the same thing as doing 50% of a classic E-mini. So again, math is multiplicative, pretty straightforward. On the losing side, we would have lost 20, we would have lost 40, we would have lost 100. So the micros give you the ability to maybe tone down the leverage a little bit. Maybe you have less risk capital that you're willing to commit to a trading account, but it gives you that flexibility of being able to trade with trade futures with hundreds of dollars instead of thousands of dollars. It's a personal preference, and everyone's different and unique in this world. Any questions on my cheat sheet? Let me know. Okay. He says, micro is definitely my risk tolerance. There's no shame in that. That's okay. Will this reply? I'm not sure, Hector, what you mean by will this reply. If you mean, is this recorded? Yes, it is. And if you mean, will I reply to questions? Yes, I do. So I'm not sure what your question was, but either way, I think I answered it. Wild Rooster, how do we transfer funds? Well, you got to ask whatever brokerage firm you're using. I mean, this is a multi-broker NinjaTrader platform, and they'll give you instructions on how to do that. All right, so let's kind of move on here. Jason, what's the most you could lose with the contract? Well, you could lose a lot. You can gain a lot, but you could lose a lot. It's literally, depending on your position, long or short, the market could rally against you or rally in your favor, or it could break down against you and break down in your favor. So, there's management things. There's stop loss placing stop orders are best practices. Placing profit target limits is best practices. Let me give you an example here. So this trade's going against us right now, right? Our unrealized P&L is minus 100. We're short 1 contract, right? And at a certain point, we're going to say, hey, I'm wrong. I'm wrong. I thought the market was going to continue to go down. I don't want an unlimited amount of losses. So I'm going to try to place a stop in, and hopefully that stop will kick in, and it will liquidate my position. And since I'm short 1, it'll be a buy stop, right? And I'm just going to go ahead and throw one in here, right here. I'm just going to right click. It's going to give me my menu, and I'm just going to click buy stop market. So there's my buy stop. So if I'm short 1, think of it as -1, and then if I buy 1 or +1, and that'll result in a 0 position, right? A 0 position or a flat position, we call it. And then the third part of my trade example would be, a profit target. And again, I'm just randomly putting these on here, guys. Don't follow follow along at home. Let's see where we at on questions here. Rez, every broker is different. You got to ask your broker, whatever broker you're using that question. Waycar, yes, you can. You could trade. You could definitely trade a live account on that basis. So one future contract costs $400 to $500. No, it does not cost $400 to $500. All is that $500 number is in the intraday margin. This is just this is just setting aside from an accounting point of view how much of your total available margin you're using to place positions, to have open positions, right? It doesn't cost you anything. This money doesn't leave your account, right? The money that you got to worry about is your P&L. Like right now on the trade we have going on, we're losing, our gross loss is $87.50, right? That's the money that's going to be either added or deducted to your account. At the end of the day, when you flatten your position, you buy it back, then this intraday margin goes back to zero, right? So it's not costing you money in terms of you're sending a wire or writing a check. It's just saying, hey, within the constraints of your $6,486 in your account, you're using $500 of that we're applying to your intraday margin, which is going to go back to zero once you're flattened your account. Does that make sense? Okay. Yeah, so from your P&L, just to be a little clear, the total P&L on the day is over here on the right-hand side. And I've done some trades, on the previous demonstration in the simulated account earlier today. So that's why you'll see I have a different number here for realized P&L. But the unrealized P&L is what's moving around right now, what's open. This is my open position right now, right? And you add realized to unrealized, and that's your total P&L, right? And you could do many trades a day, or you could do one trade a day. It's just totally up to you. So let me get into that in a second. And let me get up to Barbie first. Okay, so what just happened? Well, our stop loss just got hit. We have zero position, and that was a losing trade. We lost money on that trade, right? So I still have my profit target down here. I'm going to cancel it, and I'm going to go. So that was a good example. And then my intraday margin now is back to zero, right? It's back to zero. The position's no longer there, so I don't need to worry about it. Okay. Barbara says each contract is over 4,000, but the initial margin is 500. How much could someone lose? Is it 4,000? Or I don't understand the first part. So each contract is over 4,000. Okay, I see what you're saying. You're saying this is the price. So if the price goes to zero, right? How much could you lose? Well, you would go 4,650, times $50. It's $50 a point. Let's see what that is. Let me get my calculator out on my phone. And this is an extreme example, obviously, but let's go 4,650. Minus zero is 4,650 times $50 a point. Oops, I'm sorry, $50 times 4,650. And you're going to lose, what is that, $232,000 and $500. Now, that would be if you didn't have a stop in. That would be if the market goes to zero. That would be if the brokerage firm didn't intervene. That's not a realistic example of what I just gave you, right? That's not a realistic example. And as you're day trading, you're gonna manage your trade appropriately, right? You're gonna manage your trade with best practices. And then if you're in jeopardy of getting to a negative position, which could happen. Hopefully, you're on top of it and in close contact with your broker, and we avoid that. So, but that's a good question. So, think in terms of the difference between the purchase price and the sales price at a $50 point. Does that make sense? Okay, so Rockwan asks, can you shed some light how you could trade futures on a long-term basis? Sure, and a lot of folks do trade futures on a long-term basis. Let's think in terms of who all the participants are here, right? We have retail traders like us. We have institutional investors and money managers that manage other people's money and manage sometimes big chunks of money. We have commercial facilities. We have hedging facilities that hedge a product or a service. We have systems traders, right? Algo traders that do electronic trading and try to take up, get little inconsistencies in prices and scalp and trade quickly. High frequency trading, they're often referred to. And all these different participants. And many of these types of entities hold positions for a long period of time. And that's where the initial margin comes in. So as an example, let's say I want to buy an S&P contract right here, and I want to hold it for, a day, one day. As long as I have over $12,650 in my account, I could do it, not a problem. If I want to hold it for a month, I could do it. If I want to hold it for the whole year, I could do it. But what would have to happen to do the whole year, since futures contracts expire, this particular contract expires every quarter, you would roll your position over to the next contract month. Same market, E-mini S&P. This 12 stands for December. This 21 stands for 2021. And then as we approach March of 2022, that's going to be the next front month for the E-mini S&P. So what the trader would sell this contract and then simultaneously buy the March contract to continue with that long position that they created over a long period of time. So, and this is a frequent thing. I mean, this isn't, just a one-off. There's a lot of folks that will roll over positions to maintain a long position in the ES, the NASDAQ, whatever market you're interested in. So that's a very great question. I appreciate that. So Gary asks, how much minimum money do I need to trade 5 contracts? So I get this question a lot. So, it's risk capital only. And I guess I'd ask you, why 5 contracts? Why not 6? Why not 2? Why not 4? I would try to keep a decent, not too much of a leverage ratio in there for sure. I mean, could you fund with a $3,000 account and trade 5 contracts? Sure. Most brokerage firms will let you do that from a day trading point of view. Is it best practices? No, it's not. I've been around a long time and I've seen a lot of reasons why people have a hard time trading futures, and over leveraging is one of them. So, if you're doing 2 contracts per 5,000 or 3 contracts or 4 contracts per 10,000 in the E-mini S&P, in my mind, that's more realistic. In my mind, it's more realistic for a whole variety of reasons. But in any event, that's a great question. And then if you're doing the micros, of course, they're 1/10 the size, and you just divide everything by 10. So, okay, Nico asks, okay, do I need $4,600 to enter the market? If my account goes down to 4,500, does that mean I can't get the market anymore? Okay, so I don't think I'm explaining this properly. Let's say my account had $3,000 in it, and I bought a contract right there, just like I did. Let's pretend this account has $3,000 in it, and I bought a contract right here. Now, my unrealized P&L here is $75, right? So now I have 3,000 or 2,000, $925 in my account. Don't confuse margin or the price of the contract with how much capital you need to buy stuff with, because this is margin trading, leverage trading. So in my $3,000 account example, I'm using $500 of my day trade margin for this position, right? I only have $2,500 left, but that doesn't mean I can't hold this position. I'm not paying $4,651 for this position. Not at all. And as a matter of fact, our intention here is to liquidate this position shortly or by the end of the day, and my P&L is just going to increase or decrease by the difference between the purchase price and the sales price. Maybe that way, by saying it that way, hopefully that's a little bit better. Yeah, I'll show you, Gary. We'll do mechanics on that later. How to do a Fibonacci retracement on here is pretty easy. 4.6 is not overnight margin. In my example, overnight margin is set by the exchange, and in this case, it's 12,650 per contract. Nico, I don't understand the question. Phrase it a different way, please. So the amount of day trade. So Jason, just to recoup, you have purchasing power, right? Let's say you had $3,000 in your account. Each contract you have to allocate $500 of your purchasing power to establish a position. So if you had 2 contracts on, you'd be using $1,000 of your 3,000 for purchasing power, for permission to place the trade. If you were doing all 6 contracts on a $3,000 account, you would max out on your day trade leverage. You wouldn't have any more purchasing power. So don't think of it in terms of equity ownership. In stock trading, you own something, right? You're going to buy some shares of Apple, and you're going to own those shares in theory, right? Here, you're not owning shares. That ownership is not there. Dashel, thank you. So his comment was, so basically $500 is the down payment to get into the position. That's a good way to look at it. Yeah, we'll talk about stock options in a minute, for sure. All right, so let's kind of pivot over to, I'm just going to close this position up. Let's take a look at the market analyzer. This is just a quote board. Most of you are probably familiar with the quote board, and you can customize it really easily. And I have mine broken down according to asset classes. And the top asset class here is the stock index market, right? We got the E-mini S&P ES 1221, right? The December 2021 contract. The next one down is the NASDAQ 100, very popular, December 2021 also. RTY refers to the Russell 2000, which is small cap stocks, right? If you take the Russell 3000 and then you pull out the smallest 2,000 of the smallest companies out of that 3,000 index, you get the Russell 2000, which is also pretty popular. So it's a different type of equity index, but it's also very popular. The next one down is the YM, which stands for the Dow Jones Futures, which is, again, benchmark, blue chip, readily, you log in the morning to Bloomberg or whatever news station you're listening to, and these markets are widely quoted and followed, even overnight. And remember, overnight is where the action is, because it gives you the ability overnight to participate in a global marketplace. We have a global marketplace now. Sometimes earnings are announced after the cash market opens up. Sometimes there's going to be an event in Europe or in Asia that's going to cause some price dislocation or some price happiness that you're going to be able to participate in by logging into your futures trading account. Underneath it are the micros of the stock indexes, the smaller size contracts. We've got the MES. Pretty much put an M in front of the contract, and you're going to get the micro version of that contract. MES, which is the micro E-mini S&P, micro NASDAQ, micro YM, which is the Dow, and the micro Russell. And the prices are in sync, right? So let's just kind of, I'm going to duplicate the DOM just so I could show you how the micros in the classics. I'm going to move my market analyzer all the way back over, easy to do. And then I'm going to go ahead and change my DOM here, my trading ladder. And I'm just going to go MES. Oops, I should probably, there we go, MES. I'm going to click on it to turn it into a micro. Now, holding them side by side, micro E-mini is on the left, the classic E-mini is on the right of the S&P, and the prices are nearly 100% correlated, right? Because the basis of these markets are the same. And they might temporarily be off by a tick or so. But that's kind of, that gets in line really quickly between, arbitrage trading and market makers and all of these things. So that's kind of, it's very, very in sync. I wouldn't say 100% every nanosecond or every millisecond, but typically speaking, it's nearly 100%. And you can see it kind of move around right now, right? And it always kind of settles to the same price. All right, so that was a question someone asked earlier. I just wanted to get that in here. So let's go ahead and close that up. Let's go back to our market analyzer. Let's take a look at some of the other asset classes. We have currencies, currency Forex. And in futures trading, it's usually the foreign currency versus the US dollar, which it is in over-the-counter Forex also, with except to the Japanese yen. But let's take there's Aussie dollar, British pound versus the US. These are currency crosses. Canadian dollar, Euro FX, Japanese yen, Mexican peso, New Zealand dollar, Swiss franc. So those are the majors, right? You have the majors, and you have some minor crosses as well that are available in futures. And there's a lot of benefits to trading the futures contracts over the counter Forex. It's an example. One regulated centralized exchange, right? There's not, over the counter, you would have different dealers, different market makers, different basically markets, right? Maybe they use the same EBS data feed to go ahead and power their Forex platforms, but then, the bid-ask spread has to be, it has to be manipulated somehow. And the universe of buyers and sellers are different between different brokerage firms. Here, this is one transparent marketplace. This is one place where all, like I said, all the traders see all the same bids and offers, see the same pricing. I mean, you could probably have 4 different over-the-counter Forex accounts and buy a Euro FX, a Euro US cross at a market with a market order and get 4 different prices, right? Or even with a limit order. But in this particular case, that's not the case. It's one centralized regulated exchange. There's micros on the Forex, and by the way, there's no carry interest, right? You don't have to pay a carry interest depending on what side of the cross you're on to hold something overnight. There's not a 3 or 5 day settlement. You don't have to open and close trades. The math in the futures works out. You buy 2, you sell 2. And then that math lines up perfectly. You don't have to worry about opening and closing different positions. There's another benefit. There's micros on the over the counter. On the Forex futures, crude oil market, the energies, crude oil, micro crude oil, natural gas, unleaded gasoline, low sulfur diesel are all great energy markets. I only have a few of them listed here that are traded. And this CL market, as an example, is the Texas West Intermediary light sweet crude, which is a global. There's 3 maybe or 4 global crude oil benchmarks. WTI is the one we're looking at. Brent crude, the Dubai crude, they're all a little different in characteristics. The CL here, the WTI is the sweetest, it's the most desired because you can convert it to gasoline easier. Again, it's got 346,000 contracts traded already. It's pretty good. Metals, precious as well as industrial. You got gold, silver, copper, platinum. All of those markets are available in the futures markets. Treasuries, you have the entire yield curve. The yield curve has been big in the news these days. You literally have the ultra bond, which is a true 30-year treasury bond. This represents the longest duration. There's a 10-year note, there's a 5-year treasury note, there's a 3-year treasury note, a 2-year treasury note, and then the Fed funds rate themselves that you could trade. So you have every piece of the yield curve pretty much that's traded in a futures contract. And I started my career in the ZB, which is the U.S. Treasury bonds. The ticker symbol back then was U.S. And it was the biggest pit in the world, the biggest trading pit in the world in 1981 when I was in it. And so it's very popular market to trade as well. So then cryptos, we got the micro Bitcoin, which is it's a new contract. It's in its infancy. There's not that much volume in it yet, but it's growing in interest. And I think that's going to be a really good market to trade because it gives folks, it's a micro, and it gives folks the ability to express an opinion on micros 23 hours a day, on Bitcoin 23 hours a day, and participate in a futures market environment, right? Without the pattern day trade kind of requirement, right? And then the traditional commodity markets, grains, you got, corn, they all have Z's in front of them for some reason. Corn, oats, soybean meal, soybean oil, soybeans, wheat, cotton, coffee, sugar, which I don't have listed here. So all of these are all pretty much, globally recognized benchmark markets that traders kind of focus on and decide, and become experts in, or try to succeed in trading these. So ZB stands for 30-year U.S. Treasury bonds, Dashel, and it's not a true 30-year. So within that portfolio, there's some durations might be 26 years, might be 25 years, might be 27 years. That's basically the 30-year bond, and that's it's probably from the longer end of the yield curve, pretty popular. Okay. All right. So those are the asset classes. So setting this up, someone asked about setting the market analyzer up. I mean, you right click on there. Pretty much NinjaTrader is great because you right click on something and you get a menu that helps you customize stuff. So, you could add instruments this way. You could add blank rows. You could add labels. You could add columns. There's all sorts of columns you could add here by simply just selecting whatever you want and then adding it to the configuration section and then customizing it. So it's really, really highly configurable. I have a simple layout just because I have to show only one screen during the presentations we do. So I just have the instrument, blast price, daily volume, and then the net change. That's what I have. But that's how you just whoever asks that question, just right click. If you want to duplicate it, you want to have two of them, just right click on the menu bar, and that kind of functionality works for all of this stuff, right? Here's my Superdome. If I want to duplicate it, just right click. You could duplicate it. Alternatively, at the bottom is a series of tabs where you could actually add markets, different markets, and toggle back and forth if you don't want to have two trading ladders on your desktop. Same with the charts. Charts are very powerful. Right click, you could duplicate a window, or you could have tabs at the bottom, kind of like I do, scattered across down here. It depends on what your monitor set up. How do you like to, how do you operate? What's the best operating conditions for you? Trading is a personal thing, right? Trading is a real personal thing, and you want to be comfortable in whatever your approach is. Someone asked how to draw a Fibonacci line. When you right click on the chart itself, you right click on a chart. I'm sorry. Let me get this. There we go. Right click on the chart yourself, and you're going to get I don't know, what is this, a sub menu pop up here, and just click on indicators. Oh, this is not how you do the fib, by the way. I'm going to show you the fib in a second. This is how you add indicators. There's, all of the regular suspects and then some. This is for your technical analysis portion that most traders use. And there's all sorts of stuff that are highly customizable here. So it's really easy to add something or subtract something or take something away. MACD, you just click on it, you click the add button down here at the bottom. It brings it down to the configured section. You highlight that, and you could change customize your parameters and your colors and stuff like that if you want. And then you apply it and you hit OK, and it'll add it to the chart. And there's my MACD at the bottom of my panel. So it's really easy to kind of add this stuff. Drawing tools would have the Fibonacci retracement. You could highlight that. And then simply decide where you want to place your Fibonacci at. You know, click high to low, depending on what you're looking at, and click again, and it puts it on the chart. All right, how are we doing so far? It's almost, we're at the hour mark here. Let me kind of cruise through these questions here. So let's talk about stock options, right? Why would you do this? Why would you do this instead? Why would you do this instead of stock options? Well, don't forget, stock options expire, right? Your clock ends, right? And as they get closer to expiring, you know, depending on if you're buying or selling, that could be bad for your position. Bid-ask spreads are typically pretty big, depending on your strike price, and you might be looking at two different pools of data, right? Here you're looking at one pool of data. And other than the rollover portion of it, there's no real expiration. You could just keep rolling over your contract, whether it's crude oil or whatever it is, if you're expressing a long-term opinion on price. So, and then, you know, the stock options trading platforms are, I don't know about you guys, not easy. Not easy to figure out. We talked about margins. We talked about currency versus spot. We talked about the different types of participants in the market. Let me kind of cruise through these questions here, see if there's anything I'm missing. We do it, and to answer your question, next week, Tuesday, Wednesday, Thursday, we have a live trade setup event that we do at 10 o'clock Eastern time, where we look for trade ideas, right? And we talk about technical analysis, and we talked about, you know, what the volume profile is, which is this shaded area, histogram bars on the left-hand side of my chart, and the different oscillators, moving average crosses, and all that. We go into detail on technical analysis Tuesday, Wednesday, Thursday. I think there's a really good workspaces webinar coming up after me here, which I suggest if you're interested in the NinjaTrader platform, which I hopefully you are. They'll kind of walk you through how to set all that up. Morgan, we don't have time to talk about extensions, and that's a whole different conversation, but thank you for that. And thank you, Isabella, for typing in that NinjaTrader, the platform training link, which gives you access to all the stuff. I think Friday, we're going to have new events up there. It's going to change on Friday, but Tuesday, Wednesday, Thursday will be for sure a thing. And then let me scroll through the rest of these questions here. I heard that when you are trading ZB, that a contract costs about that much. I'm getting confused as to why it costs so much. All right, so let's just kind of go over this one more time if we can. Let me just pull up a ZB trading ladder. Let me just go ZB, our treasury bonds. Every market has different contract specs. Right, here are the treasury bonds. Now you notice that they're not traded in quarters. The price ladder is in increments, 30 seconds. This market's traded in 30-second increments, right? So you go in one whole point is worth $1,000. Each increment is worth $31.25, which is, you know, you just divide. You divide it into the, you know, it's just 1/32, right? That's how much it's worth. And so, and I'll just go ahead and do a real quick order here. So once you place an order in this particular, and it's not really moving right now. So my example we might not be able to pull it off in time, but the margin now, you can go to the top here and you can see the margin is different. It's $1,000. So the day trade margin in this particular example is 1,000 instead of 500. Of my $6,224, my excess margin is 5,224. Remember, this is just again It's if you think of it as a down payment that never leaves your account, that's a good way to think of it. I never thought of it that way. But that's, really what I'm worried about is my unrealized P&L, right? When the price does start to move around a little bit. Each one of these increments, $31.25, right? The commission that you're going to be charged for this from most brokerage firms isn't going to be any different or not much different from if you're trading in any mini S&P contract, as an example. So that's, part of your transaction cost is not only the bid-ask spread, but also whatever commission you're being charged. And then most brokerage firms are going to charge you a very low, relatively speaking, a very low commission rate. So you can see we just moved now. The price just went down one tick to 61.27 on the trading ladder. Focus on the middle. And you can see here, now my P&L is negative, right? Minus $31.25. And because, I was long, I was hoping the market would, I bought one, I was hoping the market would go up. So if I get out at this price, 61.27, I would have sold it at one tick lower, and I would have lost $31.25, plus, is my gross trade P&L. So that's kind of how it works. So the tick size is different, yeah, and the intraday margin is a little higher, yes. But generally speaking, your costs associated with the trade, other than the bid-ask spread, are going to be really similar. I don't know, Dashel. I would go to the NinjaTrader. I would go to that link that Isabella cut and paste into the chat group there, and just double check. Just click on the events that you're interested in, because there's a whole bunch of them, and just participate to whichever ones you wanted to. Hopefully that answers that question, why pricing for ZB is different. Mackerson, any position that I put in this session, Mackerson, just to be clear, is just a demonstration for demonstration purposes. We're not doing, this is not our Tuesday, Wednesday, Thursday live trading event. There's no science to those entries that I just made. I just wanted to demonstrate the intraday, initial margin, P&L, tick size, all that stuff. If there's a net, it's a good question. I don't know the answer to that question, Brett. And if there is, my guess is the volume is going to be pretty light. But I will understand. Let's see. You know what we could do? We might have time to figure this out. CME Group Markets. And when you go to CME Group Markets, this is kind of a nice little trick. CME Group Markets gives you all of the asset classes. It gives you some of the popular markets as well. So you can go to energies. They don't make it easy. You got to kind of toggle around a little bit. But it does give you information on all the different markets they have. Here's the crude complex up here, the natural gas complex up here, and you could kind of drill down by clicking on natural gas, and then it gives you a whole bunch of other market information on here as well. And you could view all the natural gas products, and then you can get into all of the different, and here they all are, and they're all, a lot of these are specialty markets, right? And some of these are options. Go through here and kind of figure out which other additional asset classes or types of markets that you may be interested in trading. And there's a whole bunch of them. Most of these are kind of obscure stuff that retail traders wouldn't trade, like me and you wouldn't trade it. So that's just food for thought right there. And I focus on the Globex column. Oops, sorry, I just clicked on Globex column. I should have done that. Focus on this Globex column here. This is different than Clearport. Okie doke. And I think we kind of. So I'm in a live sim account. Who asked this question? Morgan. I'm in a live sim account, so I have a different connection than you probably have Kinetic. My connection is. I'm sorry, mine's kinetic. I'm sorry, you probably have a different connection depending on your pathway here. So mine's completely different than yours. I'm pretty sure, because as I recall, I think you have a live account, and it'll be different. No, so Dashel, that's a great question. He says, do you have to pay to partake in the live training sessions? The answer is no. Our objective here is is just trying to provide information and education. And as you go through the, explore the possibility of trading futures over other markets, it's best to have as much knowledge as you can. And there's other presenters, arguably smarter, not smarter than me, that do other events as well. But we really we think it's important to be transparent with information and ideas. The Tuesday, Wednesday, Thursday sessions are really open to ideas, right? So we have some experienced folks in the room that, and I'm using the word room, chat room, that provide some great insight as well. So it's it's free thing. You can come when you want, and tell your friends, your family, your countrymen, anybody who might be interested. Thank you for that. Appreciate that. All right. I think if I missed your question, I apologize. I'm going to throw up my email address one last time, just in case anyone wants to reach out with a question. I'm not. I thought I had an email address on my thing. Well, it's just my name with a period between it, jim.cagnina at NinjaTrader.com. Jim.cagnina, NinjaTrader.com. So feel free to shoot me out a note. Okay, I do want to remind everybody trading futures, options on futures involves substantial risk of loss, not suitable for all traders and investors. Oftentimes in future trading, you have a high combination of leverage and volatility, although that could be an equation for opportunity, also equation for risk. Easy on the day trade margins. Look forward to seeing you guys again, hopefully. Marcus, follow that link that Isabella cut and paste, and you'll see a calendar of events. So I'll go ahead and put it in there again for you. I think it'll let me. Yeah. Oops. No. Let's see if it'll let me. No, I don't know why it's not letting me. Try to scroll back up in the question box, and you'll see not too long ago at 12:59. It's the platform trading page, or just go to NinjaTrader.com. You'll find it. Demo trader, that's just a demo data feed. No advantage. What is the purpose of live streams? Just curious why you hold these. Again, I mean, again, it's a matter of education, information, options. Everybody's got a ton of options, right? You could trade a lot of other stuff or not trade at all. And so the idea is, let's kind of use our experience. We have the NinjaTrader platform, which we think is the best future trading platform there is. And we want to use our knowledge base to try to talk to folks who might be interested. That's all. Okay, guys, I'm going to wrap it up. It's been over an hour, though. I really appreciate you guys coming today. Next week, we're going to go at it again. And just remember, be safe out there and take care of each other. Take care.